Next, we'll cover the allowance method. With the allowance method, we are not going to run into the same issue of violating the matching principle as we did with the direct write-off method. This is because at the end of each accounting period, we're going to expense bad debt expense by doing an estimate of uncollectible accounts. Instead of waiting for a customer to default, then writing them off, which could be in a different fiscal year, we will write them off. Now it's going to be an estimated amount, but it'll be in the same year as the sale. The advantages are that the expense and the sales will be recorded in the same time period, and the amount of accounts receivable on our balance sheet will be more up to date with the amount we actually expect to collect. Next, we'll be covering the journal entries for the allowance method. First, we're going to go over the estimate of the allowance. This is done at the end of the accounting year. No one has defaulted. We're just going to assume that some people will. After we're done practicing with these journal entries, I'll show you how to calculate this amount because we can do it a few ways. But for right now, we're just going to go over the journal entry portion. To estimate the allowance, we're still going to use bad debt expense because we are still writing off accounts. Instead of writing off specific accounts, we're going to credit allowance for doubtful accounts. Allowance for doubtful accounts is a contra accounts receivable account. This is the amount that we're going to estimate is going to be uncollectible. I'll explain how this looks on the balance sheet. Let's assume this is the beginning of our balance sheet. We have cash at 10,000, supplies at 2,000, accounts receivable of 8,000. The allowance for doubtful accounts is a contra accounts receivable account, meaning that it is linked with the accounts receivable account, but it does the opposite. It brings it down. The allowance for doubtful accounts will subtract from this number. Let's say we're going to estimate that $1,000 will be uncollectible. We will subtract it from here, which means our net accounts receivable, the amount we actually think we're going to collect, would be $7,000. This is all linked together, this part right here. It's 8,000 minus 1,000. We're only going to show the 7,000 on our balance sheet. This is a more updated number. We're not overinflating our accounts receivable. We think we're going to collect $7,000 worth of accounts receivable, not 8. We're being a lot more conservative by using this approach. Now, $1,000 doesn't seem like a lot, but some companies have millions and millions of dollars of accounts receivable on their books, and millions of dollars can be defaulted on. It makes a big difference showing the real amount you actually think you're going to collect versus showing the total amount. Once again, the journal entry is a debit to bad debt expense and a credit to allowance for doubtful accounts. This amount here would be the estimate. At this point, no one has come into default. It's just the end of the year. We want to update our accounts receivable to show the amount we actually think we're going to collect and write off our expenses in that same time period we have the sales. Now, let's say it's the next year and someone does come in and they default. We had a feeling that was going to happen. We already estimated it, but now it's official. Someone's writing off their accounts. Instead of debiting bad debt expense like we did with the direct write-off method, we already did that here. And we put the amount we think will be uncollectible in allowance for doubtful accounts. So we're going to take it out of the allowance for doubtful accounts because we thought a certain amount of people would default. Some people did. Now we think it's going to be a lesser amount. We're going to debit allowance for doubtful accounts and then credit the accounts receivable of the customer who defaulted. It's very similar to the direct write-off method where we did the debit to bad debt expense and the credit to accounts receivable. We just have this middle step here where we use allowance for doubtful accounts as like a temporary holding account. We're going to credit it here and debit it here so it does cancel out and we're left with the same result. Just like with the direct write-off method, we went over what happens when we write someone off and later on we can recover them. Same thing here. When we recover it, we're going to reverse the write-off. We did a debit to allowance for doubtful accounts, so we'll credit it. We did a credit to AR, we're going to debit it. Same thing with the direct write-off method. When we recover it, we'll reverse the write-off and then collect the cash as you normally would. We'll get the cash and then we're going to write off their account because they did pay us. Let's do a practice problem with this. This is number 2 on your classwork. We have Gomez Corp uses the allowance method to account for uncollectibles. On January 31st, it wrote off an $800 account of a customer C Green. On March 9th, it receives a $300 payment from Green. Prepare the journal entry or entries for January 31st and March 9th. Now this problem is a little different. I'm going to go backwards for a moment. We're assuming this part right here, the estimate of the allowance, was already done in the end of December. What we're going to be doing now is writing off the account and then recovering it. These last 2 entries right here. We are going to practice doing the estimate in a little bit. On January 31st, we need to write off the $800 account from C Green. Remember to write off the account. It would be allowance for doubtful accounts, the amount that we're writing off, and then the customer's name, accounts receivable C Green in this case for $800. Then on March 9th, they can actually pay us $300. It's not the whole thing, but they can pay us a portion of their bill. This is March 9th. We're going to have to reverse this entry we just made to write them off. It's the opposite. The debit becomes the credit and the credit becomes the debit. Then collect the money as you normally would, just like with the direct write-off method. We're getting the cash and it covers the accounts receivable of C Green. Like I said before, this problem here skips the 12/31 estimate, but we're going to be going over that part now. To estimate the bad debt expense at the end of the accounting period, there are 2 methods. One is the percent of sales method. This is the easier one. The second method is the accounts receivable method, and there are 2 ways to do this. We can do the percent of accounts receivable or use what's called an aging schedule, aging of accounts receivable. We're going to be going over all of this now. Remember, this is the estimate of the bad debts at the end of the year. We're going to start by going over the percent of sales method first. This is when management estimates what percentage of credit sales will be uncollectible. We're doing this based on the amount of sales we made. For example, we believe that 10% of all of our sales will be uncollectible. Management will use past information to come up with this percent. They will use their credit policy, depending on how strict they are with loaning out credit to its customers, and the past experience with it. It's very easy to calculate this amount. It would just be the amount of sales times the bad debt percent. If we had $100,000 in sales, and I think that 10% will be uncollectible, that would be $10,000. All you do is multiply the percent by the sales, and that would be the amount of the estimate. That would be the amount we journalize. It's very easy to do this one. We'll do a practice one. This is number 3 on your classwork. We have Warner Company's year-end unadjusted trial balance, which shows accounts receivable of $99,000, allowance for doubtful accounts of a $600 credit, and sales of $280,000. Uncollectibles are estimated to be 0.5% of sales. Prepare the December 31st year-end adjusting entry for uncollectibles. We definitely have more information than we need here. All we really need is the amount of sales and the percentage. As a reminder, the journal entry for estimating the allowance was a debit to bad debts expense and a credit to allowance for doubtful accounts. We just need to come up with the amount in this case. The date is 12/31. And like I said, the journal entry would be a debit to bad debt expense and a credit to allowance for doubtful accounts. Now let's see if we can determine the amount. Remember, the amount would be the percent of the amount of sales. Sales is $280,000, and we think that 0.5% will be uncollectible. We would multiply the 280,000 times 0.5% or 0.005. This will equal 1,400. Make sure you do the math as well so that you are able to do the percent correctly. This would be the journal entry at the end of the year. This is us estimating the bad debt expense. In this example, no one has defaulted yet. We're just going to assume that $1,400 worth of our sales will be defaulted on. We're going to expense it in the same time period we made the sale, and we're going to offset our accounts receivable by $1,400. Right now, our accounts receivable shows that we have $99,000. So on the balance sheet, we'll actually take off $1,400 of that to show the net accounts receivable, how much we actually think we'll collect.